What's up you guys, Sasha here. Now just a few hours ago, Starling went and made a really big announcement. They said that they're the first UK challenger bank that has managed to break even through amazing strategy, through their great products, through the ability to actually earn revenue and make that revenue surpass the costs of running their business. In the month of October, they said that they made a net profit where their total lending and their total fees and commissions slightly outstripped the costs of running their business, and as a result they're saying that they are now projecting an annual operating profit of £10 million based on that 1 month. All sounds great. All the media outlets, including some of the big national newspapers, have taken this and run with the story and have sung massive praises, and I personally am a huge Starling Bank fan. I am making lots of videos where I say that I prefer them to some of the other challenger banks, but I decided to go and look into these figures in a little bit more detail, and there's a couple of really massive problems. And the problems are that the numbers just don't add up. The things that they are saying and the things that they are implying, the way that they are saying them, are not really quite accurate. And I wanted to explain exactly what that is, and I wanted to explain exactly why I kind of disagree with the way that this is all being positioned, so that people can get a better understanding of exactly the position that Starling Bank currently is in, and exactly what may be happening over the next few years. Let's dive right in. Now today they released two different pieces of information. They released this trading update for October 2020 and they released a separate blog post by Anne Bowden, the CEO of the company. And in this they've provided a bunch of really interesting numbers. They're showing that there are 1.42 million retail accounts in the bank. The numbers of business accounts and the number of other Euro and USD currency accounts have grown slightly. The other numbers haven't changed that much. The deposit numbers have grown somewhat, and net everything has grown to the kind of position where the revenues have been growing more quickly than their cost base. They're saying that their revenues have been growing at such a fast rate over the last 12 months, but yet the costs of running that same business have only increased by about 30%. But here is the bit where I wanted to go into it in just a little bit more detail, and that is their total operating income. So this is just the amount of revenue they earned for the month of October is £107.7 million. And out of that £107.7 million, £65.7 million comes from net interest income. The other £41.9 million comes from fees and commissions income. So they go and sell some third-party products and they have some partners and all of that kind of stuff. That's where that kind of revenue comes from, as well as fees on accounts and various kinds of exchange fees and everything else that they do charge. So that's all that side of the business. But the number that I wanted to go into a little bit more detail was that net interest income number, because that's the number that is the lion's share, over 60% of the total amount of revenue. And I was just curious as to exactly how it managed to grow from 0.9 million in October 2019 to 65.7 million in October 2020. Now, at the top of this very report, the bank makes a statement which it tries to explain why they think this number has grown, and I am quoting here from their very report. It says, thanks to strong momentum in customer accounts and revenues coupled with a stable OPEX base. Now here's my problem. When somebody goes and reads that, when say a regular journalist goes and reads that, or when a regular customer goes and reads that, that sounds like Starling is just naturally growing their customer base and their customers are loving their product and they're using a lot. And the reason the revenues are growing are because of that beautiful synergy, because people are, borrowing more money over time and the bank is becoming better at lending the money and understanding their customers better and all that kind of good stuff. But the truth is slightly different. Now, let me show you some of the numbers. Towards the top of the report, one line that's really critical is the gross lending line. It's buried somewhat further down in that table, and it shows that the bank has a total outstanding loan book of 1.5 billion in October 2020, which is up from just 37 million pounds in October 2019 and is a third higher than in the last trading update in July 2020. Now, why is that significant? Because if you then scroll all the way down to the bottom of this very same report, you see a little breakdown of their business lending. And the business lending has two lines in it. It has BBLS and CBILS lending. there's only one paragraph in this whole section. The sections about customers and customer accounts and all of that stuff are really, really massively written about as though that's the thing that's really important. And yet this one seems to not have very much focus on it whatsoever. And I was wondering why that might be. Now, BBLS stands for Bounce Back Loan Scheme. You might remember that's the loan scheme that the government announced that the small businesses are able to get loans for up to £50,000 from a selected number of banks. And what happens with these loans is that for the first 12 months, the government guarantees the payment of the entire amount of interest due on that loan, and the business has to pay nothing. So what this means is the bank incurs absolutely no risk whatsoever because businesses cannot physically default on payments, seeing as they don't have to make any. But, and this is really important, the bank actually gets to earn revenue because the government is paying the interest on behalf of the businesses on these loans. CBILS is the Coronavirus Business Interruption Loan Scheme. This is for slightly larger businesses, for loans of above £50,000, and in Starling's case, they've dished out 358 million total in these types of loans as well, for a grand total of 1.4 billion in total lending to businesses. Now remember that the total number they had for lending for the whole bank overall was just 1.5 billion. So what we're saying is pretty much the entire amount of money lent out by the bank over the recent few months has been through this government-backed scheme. And let's look at some of the numbers in terms of how much they might actually be making from it. Now, I made a really basic Excel spreadsheet, and in this spreadsheet, I made the most basic set of assumptions. I've got the Bounce Back Loan Scheme, the Coronavirus Business Interruption Loan Scheme, a line for consumer loans and a line for consumer overdrafts. And what I've done is I literally pasted the two numbers that Starling Bank themselves have provided us in terms of the amount that they have lent out for those two schemes. And what I've then done is I have added two other lines. Now, I've taken the 100 million. I don't have any more in-depth numbers, so I don't know how accurate that 100 million is, but I'm just going with what I've got. So I've taken it and I used their last annual report, where I went and scrolled down and I found what the distribution between loans and overdrafts is for their business. And I used approximately the 2/3 to 1/3 ratio in this as well. Maybe it's changed, but I don't think the difference is going to be particularly material to what I'm talking about. Now, what I then did is I went and added the interest rates. Now, here is the interesting thing. The BBLS interest rate is fixed by the government and it is set to be 2.5%. So that means their current bounce back loan scheme entire portfolio is earning them about 2.1 million in interest income per month. Now, the Coronavirus Business Interruption Loan Scheme is not quite as straightforward. It's actually relatively flexible, and depending on which study you look at, it looks like a lot of these loans were dished out for somewhere between the 2% and the 9% mark. Now, because some of the traditional banks deal with some of the larger established firms that maybe go back a little further than the average type of clientele that works at Starling Bank, and because of the way that they price some of their consumer lending and some of their other products, I kind of went slightly on the conservative side here, and I assume that they're lending at an average of 6% here because it kind of makes a lot of sense. And I put 6% there. I think that's probably quite close to the average. Maybe I'm wrong. I have no idea. I have no data here. I'm just making some guesstimates. According to that, that would mean that their £358 million portfolio would make about 1.74 million in monthly interest. Now, next I went and looked at loans, and with loans they have a representative APR of 11.5%. Now that means that consumers who apply for their loans have to have at least a 51% chance of getting 11.5% or lower. Now I am guessing that that means that the majority of customers do not really get much lower than that, because if you were going to get lower than that, you probably wouldn't be applying for a loan that tells you that the representative rate is 11.5%. But that does also mean that some customers may be offered much higher rates if they present a higher risk to the bank. So I assumed that maybe the average that they actually end up giving in terms of the rate is 15%. Again, I'm just guesstimating here. I'm just explaining how I came up with those numbers. I then went and looked at their overdrafts, and their overdrafts at the moment are priced at 15%, 25%, and 35%, depending on the level of risk of the customers. Again, I gave the benefit of the doubt to the bank, and I presumed that, let's say that the customers who are more risky are more likely to want to go loan, take an overdraft, and actually then use it. And as a result, the average rate of interest I've set for overdrafts is 30%. Now what I then did is I just added up these numbers that I guesstimated, and I got about £5.4 million worth of interest for the month of October, which then I went and compared to how much they actually made. And this is the really interesting thing is, the bank said that they made 5.5 million in terms of net interest income for that month. So I wasn't very far off. And if you look at my numbers, it probably is not accurate in any sense when I break it down into individual things, but I would wager that I'm not a million miles off just based on the explanations that I gave you. So here is the problem. Almost 4 out of the £9 million that the bank has made in the month of October came from the government. It didn't come from the businesses that are borrowing money. It didn't come from the customers. It didn't come from any interchange. It didn't come from any fees. It didn't come from any third parties. It didn't come from anything else. Almost 4 million, so about 40 to 45% of the total amount of revenue that the bank made in October was paid by the government. And the problem that I have is that this was not mentioned at all in any of this presentation. I didn't see it mentioned anywhere within the official release. I didn't see it mentioned in Anne Boden's statement. And I feel that this is very disingenuous because this is a hugely important factor. The issue here is that these businesses that are apparently revenue generating at the moment are likely to incur substantial difficulties the moment they have to begin repaying these loans starting from April or May next year. At the moment, they have to make no repayments whatsoever, and a lot of these businesses have their shops shut, have their businesses shut, are unable to operate, are having to offload all their staff, are having to sell off all of their assets. A lot of these businesses may not even exist come the time when the repayments have to actually be made by businesses. And so calling this revenue as some kind of projection of what this business may look like in a year or two's time, I think is probably not the fairest way to make that assessment. Secondly, given that not a single one of these business interruption loans or the business bounce back loans has actually had to be paid by any of the businesses that were given these loans yet, I think it's slightly disingenuous, again, I'm using the same word, to not mention that at all in any of this paperwork, and to just not even mention the fact that this revenue is being paid for by the government and the risk from this revenue is not accounted in this report whatsoever. Now, there is one big counter to what I'm saying here, and that is the government has guaranteed these loans to the banks. They guaranteed the bounce back loans to the banks, and they guaranteed the bigger C-bills loans to the banks up to 80% of the value. So that means that if the businesses fail to make repayments, then the bank still gets those revenues. But my point being is that this loan book that they have very fast built during the year of 2020 is likely to be hugely unrepresentative of the type of lending they're able to go and give out in the future. They are very unlikely to be able to lend to businesses at a rate of, say, 2.5%, 6%, 5%, I don't know, whatever rate it is, and have an almost 0% likelihood of making any losses because the government is going to be covering their back. It is highly unlikely they're going to have the ability to go and lend such huge amounts of money so easily in such unprecedented times next year, the year after, or the year after that. And so I would say that the projection that this type of lending is any kind of indicator of what the performance of this portfolio is going to look like in the future is probably inaccurate in my personal opinion. Now, I am not privy to the details. Maybe I got all of this wrong. Take all this with a massive pinch of salt. But hey, tell me what you think in the comments below. I'd really be interested to hear your thoughts. If you like this video, please make sure you go and smash that like button for the YouTube algorithm. If you enjoyed this video and you want to see more videos about personal finance, about insight into the world of finance, make sure you subscribe to this channel and make sure you hit the bell for notifications so that you can see every single video as it comes out. Thank you so much for watching. I really appreciate it, and I'll see you guys later.